Be Wealthy and Smart, episode 1381.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the worst day in stocks this year, what caused it, and what it looks like going forward. On Wednesday, the NASDAQ and the S&P 500 sold off sharply after tech earnings disappointed. Two mega-cap tech companies had disappointing earnings, which led the broad market index down 2.2% and the NASDAQ down 3.5%. The Dow Jones Industrial Average also shed 1%. Shares of Google parent Alphabet fell 5%, on track for their biggest one-day drop since January 31st. At that time, they dropped 7.5%. Although Alphabet had a good earnings report with a better top and bottom line beating last quarter's estimates, it was below the consensus estimate, especially the YouTube advertising revenue. Meanwhile, Tesla shares declined 11%, their worst day since January 25th, on weaker than expected earnings results and a 7% year-over-year drop in auto revenue. Other major tech stocks fell in sympathy with Alphabet and Tesla. NVIDIA and Meta platforms respectively lost 6% and 5%, and Microsoft lost 4%. Wednesday's sell-off was caused by the perfect storm of an overbought market and a sharp rise in the first 7 months of this year, where stocks have gone up almost without interruption. That's why this pullback hasn't come as a total surprise to investors. Ross Mayfield, investment strategist at Baird, said, "We would view this sell-off as ultimately quite viable because it's against the backdrop of a bull market. And a healthy correction inside of a bull market is something that we view as a place of opportunity, rather than a place to get defensive or to try to shield your money from this volatility." The bright spot in the market were the small caps, where the Russell 2000 was down just 1.5% on the day. For the month, the Russell is up 8%, as investors recently began rotating out of large company tech names into smaller company stocks. This is just the beginning of earnings season, and more than 25% of the S&P 500 companies have reported their second quarter earnings, with roughly 80% of them topping expectations. But another statistic of concern that came out on Wednesday was the weaker than expected U.S. manufacturing data. The U.S. PMI Flash Manufacturing Output Index fell to 49.5 in July, which was an unexpected slip into contraction territory as new orders, production, and inventories declined. Economists were forecasting a reading of 51.5%, so it was 2 points below what was expected. That shows that manufacturing is in a state of contraction or slowing growth. New home sales for the month of June also came in lighter than economists had expected, as interest rates remain stubbornly high, but are now at the lowest rates that they've been since March, which should help the housing market going forward. There's also a handful of companies known as the Magnificent Seven, which have received most of the gains this year, so the fact that those companies are pulling back should be of no surprise. According to Peter Bachvar at the Bach Report, he said investors are finally waking up to all that AI spend and realizing it is much more of an expense right now than a revenue generator. The Treasury curve steepened on bets the Federal Reserve is close to cutting rates. William Dudley, former New York Fed president, called for lower borrowing costs, preferably at next week's gathering. For many analysts, such a move would be worrisome, as it would indicate officials rushing to avoid a recession. Canada cut interest rates for the second time this year, 0.25% this week. Kathleen Brooks, research director at XTB, said the market is not impressed with the start of earnings season for the mega tech stocks. There was a lot resting on these results, and we don't think that they gave clear answers to questions about the effectiveness and profit potential for AI right now. The S&P 500 is still up about 15% year to date and trading close to 22 times earnings. As far as quarterly results, broadly, second quarter earnings season is off to a weaker start than usual. Among S&P 500 companies that reported results, Profits beat analyst estimates by the smallest margin since the end of 2022, while sales surprises were the worst in at least 2 years, according to data compiled by Bloomberg. So a pullback or a correction in the stock market is not unexpected. With the stock market heading up so sharply this year, we were definitely due for some consolidation of gains. I think it's going to be a little bit rocky this summer, and it's a good time to take some profits off the table, just in case you get an opportunity to buy lower later. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button, and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.